All right, welcome everybody to the webinar here with apexinvesting.com and Nadex. And what we're going to do is we're going to talk about how to put fear and greed in check. My name is Daryl Martin, and I am the founder of apexinvesting.com. I'm also a full-time trader. I've been trading for over 10 years. I've been trading Nadex for 7 years. And we're going to dive into a new special contract that Nadex has come out with and help you understand everything. It's important that you do understand that there is risk in trading, and it may not be appropriate for all investors. So make sure you know what you're doing before you do it, and whatever choices you make are your own, okay? One of the big things I'd like to point out is that on a lot of different disclaimers, you'll see that you can lose more than what's in your account. On Nadex, you'll notice the contracts are designed so you cannot lose more than what it costs for you to enter the transaction. So all your risk are capped, okay? Again, all your risk are capped, so you don't have to worry about losing more than what's in your account when you trade on Nadex, which is a great benefit. Let's go ahead and dive into our topic today, which is touch brackets. And touch brackets are a contract that Nadex launched late last year, and they're just getting better and better and better. I love them as a trader. I've been trading them myself. I'm going to show you some examples of trades I've placed. And we're going to dive into, what is a touch bracket? We're going to talk about optionality and what that means regarding touch brackets. We're going to talk about markets and the markets you can trade, how the touch brackets work. A thing called sort of a no quote zone. It's more of a caution zone. And I'm going to go into that. As a trader, I thought this was really important to explain to you as traders, that you understood this one. It's a little tip, but it's a tip that can be really important. Expirations, we're going to talk about when they expire, because it's completely different. I'm going to compare the call spreads versus the touch brackets, because I didn't know that's a big question that has come up as I've been training traders already on this at apexinvesting.com with our integration stuff, but I'm going to go into that. We're going to talk about capital requirements and how it works. We're talking about risk and reward. We're talking about trading considerations, and we're going to go into examples of live trades. Okay, so with that, let's go ahead and get started. And feel free to ask me any questions you want to, and I will, if they're on topic, I'll answer them. If not, I'll answer them at the end of the webinar. But I want to go ahead and just make sure that you got everything you need and that you understand the foundational pieces of touch brackets on this video today. So what are touch brackets? Well, Nadex Touch Bracket is a contract that trades in a defined range. Okay, so it can go up to a certain price, down to a certain price. The lower price is the floor, and the upper price is the ceiling, and that's the range it can be traded in. And I'll show you an actual example here on the next slide. Between the floor and the ceiling, the price moves with the underlying market, and so basically tracks along with the indicative index, actually. And so what you want to do is, if you want to trade a contract like you're trading, say, a future contract or a forex contract, these touch brackets are excellent because they actually move in line with those markets. If the Nadex indicative index, which is based on the underlying market price, touches or surpasses the floor or ceiling, that contract is expired for that value. Okay, again, if the Nadex indicative index goes above or below the floor or ceiling, then it expires for that value. So let's get some visual representation, and we'll go back and forth on this to help put all the pieces together, okay? So what I want you to see right here is this is an example. If you go and you click on touch brackets inside of Nadex, and you chose, say, the dollar franc, okay? You'll also see them on the mobile app, like under weekly contracts is where you'll see them. So right here you see dollar franc, you see the bid offers, you see the floor and the ceiling, okay? Right there. So this price you can sell at, price you can buy at, that's the size. Size has actually increased quite a bit. I think they're up to 20 now, and they refresh them pretty quick, and they'll be adding more and more, I'm sure, as more market makers come on. And but I've had no problem getting in and out of trades that I've been doing. And again, dollar franc right here, floor and ceiling of the 4 touch brackets. And so what they'll do is when the market opens up, when they start trading at the beginning of the week, then they'll immediately list 4 brackets on each market. And if it's a FX market, it'll be $50 below will be the floor, and 200 points above will be the ceiling. They'll also have bracket number 4 over here, which is $50 above and 200 points below. The great thing about that is that means you have a low risk high reward potential, or capped risk, but smaller risk compared to a larger reward potential all the time when it opens up. And then they'll have some in the middle, so as the market moves, then there'll be other contracts that constantly give you those opportunities where you can have a smaller defined risk with a larger potential profit. Now, what about optionality? Because if you've traded Nadex before, or if you traded options before, then you've dealt with optionality with delta, gamma, vega, rho, all that stuff, all those complex Greek terms. Well, you don't have to worry about that with touch brackets because they're literally priced relative to the underlying market. So when implied volatility is really high or really low, you can use the touch brackets either way. It's not going to impact the price of the touch bracket contract. If there's a week until expiration or 10 minutes till expiration, it's not going to affect the price of the touch bracket. It's just based on the underlying market in between the touch bracket. Now, this is important. This is where the word touch comes in on the brackets. If the floor or the ceiling is touched, you instantly will lock in your maximum profit or loss. Like, if you're long and the ceiling is touched, you're going to get maximum profit. If you're long and the floor is touched, you'll take maximum loss on the contract, as it will immediately expire at the full value and be paid out. And I'll show you what a payout looks like on a full value expiration as well. You can't stay in past the floor and past the ceiling like you can on regular, like on the Nadex call spreads or on like vertical spreads, call options, things like that. So, pay attention to where the floor and the ceiling are when you're trading these contracts. I mean, you may want it to be really close because maybe you want a really low risk trade with a really defined stop. And you can think of the touch as like a stop out. Okay, because again, when that indicative index touches the floor or ceiling, it's going to stop out of the trade. It's going to expire out at either full profit or loss for you, depending upon your direction. So let's dive into a little bit more of how they work. And then again, I'll show you another visual example on the next slide here. One is, you may have noticed I dropped the word weekly earlier if you're looking for them on the mobile apps and things like that. They are weekly expiration. Okay, they're trading on the last day of the week. So you don't have to, there's so many benefits, but the first thing I do want you to understand is you have the entire week for them to trade. And at the beginning of the week, they'll list those 4 brackets for every market. If a floor or a ceiling is touched on any of the brackets, they instantly list a new bracket for you. If there's a big market gap and it jumps past 4 brackets, there'll be a circuit breaker that will halt new brackets till things calm down a little bit. Okay? In almost all conditions, there will be 4 unique touch brackets for you to choose from. So let's look at an example of how the touch brackets work. Okay? So this is the same sample I showed you earlier. And on this, what will happen is, like I told you right here, market opens up, they list 4 touch brackets. Well, let's say the market moves and it touches, right? Goes above this bracket right here. When it goes above that price, it's then going to populate a new bracket, 50 ticks below, 200 ticks above. That's on forex, okay? And then that bracket is going to be gone. And of course, if it goes back down and hits bracket 5, it'll pop a bracket 6 up, which will look like bracket 4. If it went down and touched the floor of bracket 5 there. So each time it hits the floor ceiling of a bracket, it's going to populate a brand new bracket up for you. Really simple. So what does that mean to you? That means as a trader, I always have a contract to trade. Some other contracts that you may have traded, maybe the market went beyond the tradable contracts. This will always have a contract to trade. And you don't have to close it out just because, the day is over. The contract goes all the way through Friday. So you don't have to deal with, rollover. You don't have to deal with margin increasing. There's a lot of things you don't have to deal with using the touch brackets. And I'll dive into that as, we keep going. So that's how the touch brackets work. And then let's see here. Now, let me show you another example on the dollar franc. That's something that's really important that you understand. Okay? On the dollar franc, now this isn't just dollar franc, this is any one of the touch brackets. There could be an area where there's not quotes. Now, there could be quotes there. A trader could place a quote there, Market makers could decide to place quotes there, but be aware on the edges. It's basically 10 ticks at the current moment. Now that could go down to 5 ticks, whatever. There probably won't be a quote. Now, why do you think there won't be a quote if the market is, the indicative index right here, you can see it's 99.02. It's only 5 ticks away from 99.07, right? Actually, like 4.4 ticks away from 99.07. So it's only 4.4 ticks away. Well, yeah, you might love to sell that contract for only 4 ticks of risk, but who wants to buy that contract for only 4 ticks of profit, right? So just from a risk-reward standpoint, it doesn't make sense for a trader or a market maker really to be listing, a bidder offer on that contract, at least not an offer that would allow you to buy as a bid. So or allow you to sell. So just think about that as on the 10 ticks before, the ceiling and the 10 ticks before the floor, probably not going to be quotes. So, or, may not be quotes. So use caution and make sure you put your, if you're putting a limit take profit in, either, write it to the end of the touch bracket, or you probably may want to consider getting out before the 10 ticks. Like if you put it in to get in 5 ticks before, and you have an order sitting there to sell to get out, chances of somebody buying that are pretty slim because it's so close already to the ceiling. And as you see, there's no quote there. So you'd have a sell, but who's going to buy it? So, and you put in the sell, like if you bought it, you'd put a sell in, it'd show up as an offer, who's going to buy that contract? Because it doesn't make sense. So make sure you put your take profits in, in a point that makes sense on the contracts. And what I've seen so far is about 10 ticks. All right, so weekly expirations. I want to, sort of harp on this a little bit because there's some pretty cool benefits. You can do, instead of just doing day trading strategies, you can now do longer term strategies. So you can put a trade on Monday and trade the, Friday. You can put on Wednesday and trade the Friday, Wednesday and trade the Thursday. You can hold it past the close versus just the contract expiring out like at 3 or 5 o'clock. This allows you to use longer term time bars. So instead of using, say, like just 5-minute bars or 10-minute bars, you could use 4-hour bars now when you're trading these contracts, 2-hour bars. If you use, tick-based bars, you could use, instead of using just like a 10-tick bar, you could use 20 or 40 or 80-tick bars now. So it allows you to really look at some longer term strategies and even trade some of those slower moving markets, but that may have, nice smooth trends. Well, now you have, a week to be able to actually do that trade. You can hold them overnight. So, you don't have to just close the trade out and open it back up. You don't have nighttime margin. So, if you're a futures trader and you go in and you put on a trade, then your margin is going to go drastically up. Like if you get this kind of day trading margin of $500, it's going to go up to, like $6,000 just on the S&P 500. And I'm actually going to show you a couple margin examples. All right. And with this, you don't have to be afraid anymore of, margin going up on you. You actually are able to have defined risk, which puts your, fear in check of losing too much, and it puts your greed in check by actually taking your profit at max profit if it hits the other side of the trade. So it's a lot of cool benefits. We'll keep talking about them as we go. Now, what markets can you use to help put your fear and greed in check? Right now, you can trade euro dollar, pound dollar, dollar franc, dollar yen. You can trade the S&P 500 E-mini futures, or what's called the US 500 on Nadex, the US Tech 100, which tracks the NASDAQ futures, the Wall Street 30, which tracks the Dow futures, and the Small Cap 2000, which tracks the Russell 2000 futures over on the CME. And I'm sure they'll be adding more contracts as well. But, a lot of times we go in to do trades and we don't have that perfect defined risk and take profit. Maybe we have an idea, maybe we have a plan, we don't always follow it. And these touch brackets allow there to be a built-in trading plan for you. And if we go over and look at, call spreads, some of you may have traded call spreads before, right? And over on Nadex, and you're like, what's the difference between a Nadex call spread and a Nadex touch bracket? Well, the first one is expirations. You don't have expirations every 2 hours and every day. You have a weekly expiration, but you constantly have contracts. So you have weekly expirations on touch brackets. Optionality, you deal with optionality with premium, where the price isn't the same as the underlying market, where it may not move, often doesn't move at the same speed as the underlying market on a call spread. So you get in and the market moves 10 points, and you only see your call spread move 5 because it's a call spread. That's how they work. That's how the vertical options work. But on the touch brackets, they're made as they have the touch. They don't have that optionality. They're going to move in lockstep with the underlying market, and specifically with the indicative index. And then now, what if we go and we look at the volatility impact? Well, one of the things that I've had a hard time with, especially recently, is I've had contracts where just in October, the Dow moved 250 points, and I literally saw a 50-point move in the call spread because the implied volatility was so high. Okay, well, on a touch bracket, if it moved 250 points, you'd get 250 points. So you don't have to worry about high IV or low IV or any of that. You can literally just, as far as impacting the price of the option, you actually can just trade the contract itself, the touch bracket, with the underlying market. Trading strategies. So the call spreads. Call spreads, I mean, you can do things like iron condors. You can do, sort of a credit spread type thing where you're, collecting premium. You can go in and you can do straddles where you're going both directions. You can use them to hedge off. You can use them to do sort of like a covered, put, covered call. You can do a married put, married call. You can do dynamic hedging. There's a lot of things you can do with them because their options, they have a lot of choices. The touch brackets are pretty simple. It's you're buying or you're selling. Okay, so you're buying, you think it's going to go up, you buy. You think it's going to sell, it's go down, you sell. So you don't have all the different, brush strokes, but you're keeping it simple. You're looking at your charts. You're making your trades based on which direction you think the market's going to go. So what happens if either one of these contracts touches the price, the floor ceiling, if the underlying touches it? Well, the touch bracket itself, it will actually expire out at max profit or loss. That can be a good thing, could be a bad thing. It can be a good thing because, like I said, it can actually help keep your fear and greed in check, and you can actually get that maximum a lot faster. So you go in and market goes against you, you can't move your stop, move your stop, move your stop like you could on futures and forex, right? But on a call spread, you could stay in, because if it goes below the floor on a call spread, you can just stay in the trade. Now, you may not be making anything, you may be way down, and it may be moving really slow, but you can still be in the trade. Now, if you go back in your favor, you can do great on a call spread. Now, on a call spread, it could go way into your favor, above the ceiling, still not have max profit, and maybe you don't take the trade because you're trying to get the maximum profit, and your greed's taken over. You're like, hey, it's up here, but yeah, I want to make more. I see more profit potential. I'm going to stay in the trade. It turns back around on you. You give up all your profit. The touch brackets will hit that other side, hit the max profit, and automatically exit you. So your greed is automatically put in check. Now, if you want to keep going, just top in another touch bracket. There's always a new one popping up, okay? But it'll help you lock in profits along the way as you go by it touching that. So again, that's how it helps keep fear and greed in check. Now, where can you trade touch brackets? You can trade them at the North American Derivative Exchange, which is a regulated exchange under the CFTC's regulation in Chicago. It's Nadex.com is the website. And if you go to Nadex.com, you can grab a demo account under trading. And so you can try these things out yourself and see how they work. And also you can get a live account and fund that when you're ready. But definitely check out Nadex.com. That's where you can trade touch brackets. And again, it's inside the United States. Their office is in Chicago, okay? Regulated by the CFTC, the same group that regulates the CME. So, you're not trading some offshore something, whatever, somewhere. You're trading something right here in the regulation of the U.S. So make sure to, take advantage of that. And they have more contracts than touch brackets. They have call spreads. They have binaries as well. So they're always adding new markets and new types of trades or trading instruments. Now, the second way a touch bracket can expire, I talked about if it touches, it'll expire. The second way is just time, like you had Friday. So they're a 1 week duration contract, like we talked about, and they expire on the last trading date of the week. Usually that's going to be Friday, unless it's a holiday or something like that, okay? The expiration value will be calculated per market the same on binaries, touches, and call spreads. Really what that means for you is they use the exact same settlement index, the same formula, which is they take the last, on futures, they take the last 25 trades, take out the high 5, low 5, and average the middle 15. And on forex, they take the last 25 mid trades, take out the highest 5 quotes, the lowest 5 quotes, average the middle 15. And they do occasionally update those formulas to do whatever they can to make sure that the markets can't be manipulated, which I think is excellent. And but when it expires, if you bought at one price and you sold at another price, the difference is your profit and loss. And I'll show you an example of a live trade where the contract was bought and held to expiration and what happened. Okay, so I'll show you one of those here in just a minute. Now, regarding capital requirements, okay, so again, going into capital requirements, you know your risk, your maximum risk before you place the trade. Your risk can never increase, you can never lose more than what's in your account. So these capital requirements equal your maximum risk. All right. It won't change when it rolls over. There won't be a margin increase. Like in fast markets, if you're trading futures, they can say your margin's going up. You don't have to deal with floating profit and loss, meaning like, okay, you had to put up $500, but now you're down 200, so now you need to put up 700. That doesn't happen. The maximum capital is put up front. It'll never increase on what you have to have. So you don't have to have margin plus P&L or day trading margin turning into, maintenance margin, things like that. So you don't have to worry about that at all. Buying and selling are the same. All right. And then there's a multiple bracket structure, which are designed to minimize your capital requirements. There's also, you got amazing leverage. I'm going to show you an example comparing the leverage on these contracts. And you don't have the unknown risk issue going on with it. If you're used to forex, it's not a big issue right now because there's not a lot of interest, but you don't have to deal with carry on these trades. Making or paying really carry being the issue you'd have to deal with when you're trading forex. You're also trading forex on an exchange, which means that the exchange is not trading against you. It is independent. It makes pricing pricing is transparent, but the traders are anonymous, so nobody knows who's on the other side of the trade. So whoever takes your opposite side of the trade doesn't know who you are. And so the capital requirements are all held at Nadex with max capital on both sides. They match the trades and they do the payouts all instantly as you're placing trades. So it's a great way to trade and help manage your capital as well. Now, like I stated, there are several markets available for touch brackets, and they trade. They're a little bit different. On the currency pairs, you got euro dollar, pound dollar, dollar yen, dollar franc. One of the great benefits of trading these touch brackets, you don't have to convert dollar yen to dollars and dollar franc to dollars. Everything is a dollar. Every pip is a dollar. Okay, so you're not dealing in francs and yen and all these other currencies. Even though you're trading the dollar franc, it's treating every pip as if it's worth $1. So it makes it really, really simple. The boundary, the maximum value is 250, which means that you'll have on an initial or on a new, we'll say on a new bracket, you'll have $50 of risk and $200 of reward potential. Okay, on the FX pairs. Now on the stock indices, it's a little bit different. You got the S&P, the Dow, NASDAQ, the Russell. On the S&P, the Dow, and the Russell, the value is $500, maximum value. Okay, so on a brand new bracket that pops up, like once one has been touched, it'll be $100 risk with a $400 reward potential. Okay, so every time it's touched, it's not in the middle, it's not somewhere else. It's always a $100 risk with $400 reward potential. Okay, now you got the NASDAQ, which is $600. All right. And that one is going to have a $120 risk with a $480 reward potential when it pops up. So it's the only one that's a little bit different. And one thing about the NASDAQ, which I like I think this is one of the many improvements that Nadex is constantly making, is they made the NASDAQ spreads, touch brackets, the NASDAQ touch brackets now tick in quarters. And so they actually are great. They move right with the underlying market. They're ticking the same as underlying market. And it works really well. And there are advantages to having, things ticking in 0.1, but on NASDAQ, quarters is optimal. And, definitely want to hop in, check those out. So if you're looking to trade NASDAQ, you like them, then touch brackets may be the place you want to go for trading, with defined risk right here on Nadex, on the NASDAQ touch brackets. So let's look at a example of risk and reward, okay? So if I go in to buy this S&P 500 touch bracket, and let's say the S&P 500 is trading at 2720, okay? And the touch bracket is 2710 to 2760, okay? So it's 50 points wide, right? 2710, 2760. And from where the market is now to the floor, there's a 10-point difference, all right? So we're 10 handles below the current price. And that's where the floor is. 40 handles above the current price is where the ceiling is. So for futures, that range would be, 50 points or a $2,500 value on, a futures contract itself. On Nadex, that same range is simply $500. Okay, so $10 a point for this versus 50. All right, so we're talking $10 $10 a point. So if there's 10 points, $10 a point, you're going to have $100 maximum risk on the trade. All right, so to help you out with that again, you got 10 points, 2720 to 2710. 10 points, every point worth $10. So that's $100 risk. And then you got 40 points of profit potential. Okay, at $10 a point, that's $400 of upside potential if the underlying market trades all the way to the upper bracket. And we've seen some moves definitely hitting these brackets. So remember, the bracket pricing is to be a lookalike for the underlying market. So the pricing is going to be very close, almost point for point or tick for tick. So it really is just like trading the futures contracts. Using the touch brackets, you can trade in and out of your position. But if you're coming up to the close and have a winner on, you don't need to close out anymore. Like if you're like right at the close right there. Your risk is always defined. You're not going to have to worry about a margin call or the contract expiring. So again, you can hop in this trade. If you go up, you can hop out, and then maybe you decide to go short. Maybe it comes up here and you take profit. And now, on a 50-point wide spread, and looking at this one's a 27.38 and a 26.80 contract, so it's 50 points wide again. And you hop in this one, you go short at 27.20. Okay? And because you decide that you think the market's going to go down now. And so you got 10 points, every point's worth $10, so that's $100 risk. And you got 40 points of profit potential, that's $400 of potential profit you can make on the trade if it comes all the way down to the touch bracket. Again, if it's in at 27.20 and it comes down to 27.10 and you get out, you made how much? You made 10 points, you made $100, okay? So, you can get in and out of the trade. If it comes down to, 2,700 and you got in at 27.20, then you'd make how much? You'd make, $200. So, because you made 20 points at $10 a point. And yeah, you don't have to do one. You could do, 10 contracts, 20 contracts, whatever. So you can do as many contracts as, you're able to put in there, and as many as liquidity is available. But that's how the risk and reward works. And again, that puts a plan in place where if the market's going against you, you can't sort of, I myself, we've all done this. You can't be stupid, right? It's gonna stop you out of the trade no matter what. So if you don't get out, now I could get out at 27.20. If you go to 27.25, I can hop out of the trade, take my $50 loss. Okay? But if for some reason I don't take whatever my planned stop is and it keeps going, I have a maximum stop. And let's say I don't take profit because I think it's just going to fall all the way down to the center of the earth, or if I think it's going to fly all the way up to the moon, well, it's going to take me out of the trade at maximum profit, and then I can put on another lower risk contract compared to reward if I want to do that. So again, putting that whole fear and greed trading plan in place. So touch brackets can be exited before expiration, right? So again, like I said, you can get out before expiration, or if the level is touched, they'll be, obviously they can be exited. That's before expiration. So the buyer side maximum risk is the difference between the buy price and the floor, like we just saw in the example. And the seller's maximum risk is the difference between the sell price and the ceiling, like you saw in the past example. So just to show you that again, maximum risk sell price and the ceiling, maximum risk buy price and the floor. Okay? That's how risk and reward works. So Profit and loss, whether you get out or your maximum profit, maximum loss, whatever is achieved, then you can take advantage of the profit and loss on that. Now, if it expires, so the settlement price is still within the touch bracket range and it expires, it's called a variable payout. So if I sold, if I go over here, if I sold at 27.20 and it expired at 27.10, then I would automatically make that 10 points, that $100, and I get a $200 payout. And I'll show you what I mean by that, how that works. But I get my $100 back because I put up the maximum risk, and I get $100 in profit potential. Okay, so or actually locked in profit at that point because it expired out. So again, I want to remind you, you could sell here and then buy back here and be out of the trade, right? If I bought here and let it go all the way up and touch, it automatically knocked me out of the trade at maximum profit. If I bought here and it hit the floor, I'd be out at maximum loss. If I sold here, okay, and then the market expires, then it would automatically expire out and, do that variable payout. Like I said, I'll show you some examples of variable payout. But just remember that you can exit yourself. It can exit by it touching, or it can exit by the expiration, which is at the end of the week. All right. With this, it is a built-in trading plan that helps you manage your greed and fear. So there's a maximum loss that you can't hold on to the trade longer and take larger than the planned loss. There's a maximum profit where you can't hold on to it longer and give it all back. So, just take it, really soak that in. There is a trading plan that will help you. How many times would you have been better off if you would have just taken the maximum, if you could have taken your stop? How many times would you have been better off if you would have taken profit when it was, flying in your favor, but then you let it all come back? Well, this lets you take care of that. If, maybe you have a platform issue, browser messes up, whatever. Maybe you have a computer issue and it crashes. Or you have an internet issue and your internet goes down. Well, you have a plan in place, a maximum profit, maximum loss, automatically in place if things just all go haywire. If the market just explodes, you have a plan in place. So now, again, you can still enter and exit, before touch or before expiration, but if you don't, you have that plan, again, in place. So to look at, another example for you, let's say you got, a floor here and a ceiling here, and you buy at 99.07 over here on the dollar franc. Okay, so market's at 99.07, 99.13, whatever, but you get in right there, let's say at 99.07, and then the market moves around, all around, but doesn't touch the floor or ceiling. I mean, it got really close, didn't touch the floor or the ceiling of the contract, expires at 99.90. Well, then if you bought at 99.07, expires at 99.90, then you're making how much? You'll make $83. So you bought here, it expired here, you make $83. Okay? So if it would have hit the floor or the ceiling, then you'd take the maximum profit or maximum loss on that trade, which would be the difference between where you entered and the floor or the ceiling. These are a couple live trade examples that I did, and so I just want to go through them with you, just to sort of show you examples. And, got in the trade, dollar yen and the Dow with short on both of them, and had a couple days left till expiration. This one after I get in, it moves a little bit. I break even. This one I'm up $91. A little more time passes, and I'm up $26 on this one. I'm up $134 on this one. Okay, and then the market just flies down overnight, and you can see right here it flies on down, and I'm actually able to take maximum profit on the trade. But let's look and see what happens. Okay, so I get in the trade, and first we want to calculate our risk. Well, if I bought at 109, if I sold at 109.41 and the ceiling is 109.59, that means my maximum risk was $18 because my risk is where I sold to the ceiling if I'm selling, right? It's where I bought to the floor if I'm buying, but I sold in this case. So I sold at 109.41. There's the price. The ceiling is 109.59. Subtract those, you get $18. One contract, 18. That's not bad margin. If you think about how much you'd have to put up if you want to go over, you put somewhere around $200 to do that trade on FX, spot FX on a mini lot. So $18, not bad at all. So I put up $18 in maximum risk. The worst thing that can happen is the market moves 18 ticks against me and knocks me out of the trade. Market flies down and it goes below the floor of 107.09. And I mean, literally, like just flies down. And the payout amount is $250. Now, did I make $250? No. Okay, that could be a little bit tricky. The expiration type was touch because it touched the floor. And so the payout amount, $250 payout. $18 risk. Remember, I put my full risk up front. I can never lose more than what I put up. So my net profit on the trade is $232. Now, net, of course, less $2 for fees. All right. But so I made $232 on the trade itself. And not a bad payout right there for an $18 risk. That's pretty good risk reward. Now, if I go over here to the Dow, okay, and the Wall Street 30, 29.10 to 23.410, and I sell it at 23.360. So right, pretty much when this one came out, right, that pricing model, I had the risk of $50 with the reward potential of $450. And how did I get that? I took the sell price, okay, minus that from the ceiling, and that's my risk, $50 on the trade. Market flew down on this one. It touched the floor, went past it actually at 22.910, and I got paid out $500. Again, I didn't make $500. I got paid out $500, which means they paid me back my $50 in risk plus the $450 I made. So I risked 50, I made $450 on the trade. Less the fees there. So again, pretty nice risk reward potential setups constantly happening. These aren't like rare risk reward setups. Remember, they always pop up with, like say a $50 risk on FX. They always pop up with a $100 risk on indices, or 120 on NASDAQ. But, as the market fluctuates, you can get it in for even less risk. So just, be mindful of where that price is, that it's not too close to where you, want to enter that's acceptable for wherever your stop is. Now, here's another example. On this trade, I hopped in and I went in and I sold the dollar yen, 108.49, and the market was the ceiling was at 108.91. So my risk on this trade was $42. Okay, so $42 on this trade. This one did not make it to the floor of the ceiling. This one expired. Okay, so it expired at 108.51, and I got paid out at $39. So did I make $39? No. I had a $42 risk. I had a $39.10 payout. So my risk was $290. And how did I get that payout again? That was the difference between where I entered and where it expired. Okay? Or where I entered and where I exited would work the exact same way. So that's, some examples of how, they play out. And again, hop over and demo and, put some on and just see it all work out. And then, of course, go to live when you're ready. Now, what about effective leverage? This is one of my favorite parts about these contracts. If I hopped in on this trade, then there would be, I had to put like 11 grand in value on the contract. And on the euro dollar, the value would be 11 grand. I wouldn't put up 11 grand. So, and the margin would be $228. So margin $228 on that trade. The leverage would be 50 to 1. So not that bad, going to get 50 to 1 leverage on it. You don't get any discount for day trading margin on spot FX if you're trading, the spot FX. And then, so it would take one Nadex contract to equal one mini lot on spot FX. Well, the capital on that would be $50. So I put up $50 instead of $228. That'd give me an effective leverage of 229 to 1. So really, that's just when they pop out every time with $50 right there. So really, really good leverage. But again, it can't lose more than $50 on the trade. The S&P 500 futures, that's worth $124,000 at the market price at 24.8575, and margin is $6,000. Day trading margin get discounted down to $500. So the leverage is 248 to 1, and the capital requirement, if you're trading Nadex, if you did 5 contracts, because it takes 5 of them to equal 1 future, because they tick in $10 a point, whereas the futures tick in $50 a point. You put up, $100 on each, that's $500. So I get the same effective leverage is day trading margin, 248 to 1, but I can hold it past the end of the day. I don't have to worry about that. And my margin doesn't go up in a fast market, and they can't change the margin while I'm in the trade. So I don't literally have anything impacting me. Like, that's the maximum risk I put up. That's the maximum dollars I put up. Doesn't change with P&L, doesn't change with rollover or any of that. So very powerful, effective leverage. And one thing I want to let you know about is if you want to make it really easy to trade these contracts, check them out over on the spread scanner at apexinvesting.com. It's free. It has touch brackets, call spreads, binaries. It does all the calculations automatically. It shows them to you, risk, reward, everything. Has instant submits, even lets you place stop orders. And again, that's free. Go ahead and check that out. And we have a lot of education and trading rooms as well at apexinvesting.com. Again, my name is Daryl Martin. I want to thank you so much for joining us on this presentation today. And if you want to learn more about touch brackets, hop on over to apexinvesting.com and make sure to set up your demo account at nadex.com and fund your live account as soon as you're ready. And again, I want to say thank you very much for joining me on the presentation today. Look forward to talking to you soon.